edition of the Buddy Study Group, and we are resuming the study hall sessions today. So it is going to be a short-term care study hall. And as I was saying before we hit record, I think this is going to be very much market oriented today rather than talking about specific carriers. Of course, we'll talk about the major players and we'll talk about what updates we've seen. But I think for today, a large part of the discussion is probably going to be an overview of the short-term care market, what we see developing, our thoughts on it. We'll talk through, obviously, ideal clients and all that good stuff. But I would love to hear your thoughts on whether it be specific carriers, whether it be the short-term care market in general, whether you have short-term care case studies that have really helped out a client that you think sharing would help. I think we can all learn from each other. We do a really good job of that on these study hall sessions. So feel free to speak up. But just to get us started, short-term care is, I mean, a lot of these solutions aren't new, right? But a newer kid on the block as far as we're all concerned and with how long we've been doing this. And it really started to emerge from, needing a market, number one, that is a little bit easier on underwriting. But number two, I think short-term care is also a really good affordability play. So I think that's where we started to see these emerge. I think from a carrier perspective, from a product design perspective, this product can certainly make sense as well, because since we're dealing with very limited benefit periods on these plans, we have a much more predictable exposure on the carrier side to be able to work with. At the worst possible claim, I know I'm going to be paying claims for a very short amount of time. So I think it can be a relatively appetizing market to get into for carriers. We haven't seen too many new major players in the industry of late. But I think just from a ground floor, that's how I kind of start by laying out short-term care. Of course, one of the limitations being state availability, right? Many of you may not have worked with any short-term care products purely because short-term care as a product has not been approved in your state. So that can be a limitation, but I think even if you're in one of those affected states, you're more than likely going to do a case out of state at one point or another. So it makes sense to have short-term care on your radar as an arrow in your quiver, because it can fit a lot of holes that you may have with specific clients. Mark, do you have anything you wanted to add, discuss here?
Yeah, those are the biggies. But yeah, I do want to add a couple of things. One is that I think it's really important to give clients an option to get a starter plan. We talk about this a lot in the worksite side as well, but that's how I view short-term care is think about what getting the first year covered can do for a family to help them plan further for the future instead of being totally reactive in a crisis situation. I like that short-term care has a 0-day elimination period, for example.
Gap fill, huge strategy.
Allows you to fill in the elimination period cap. I like that it goes up to certain ages. So give you an example, my father-in-law, 85 years old, did not have any long-term care insurance, could not get any long-term care insurance, could get short-term care. And I'm thrilled, my wife is thrilled that he has the 1-year plan just to help when that time comes, get that professional care as a supplement. So, there's just a lot of stories where I think it just makes a ton of sense. Also, I like that there are now some carriers that are thinking about filing as long-term care, but building a 1-year benefit and simplified underwriting. So I call it short-term care. I mean, it's essentially the same thing, but doesn't run into the regulatory issues of having a true supplemental health filed product. So we can get, Bankers Life is a great example. They kind of trailblazed this, and believe it or not, they're the number one traditional long-term care carrier in the country in terms of sales now, because there's a lot of demand for a affordable 1-year simplified, underwritten long-term care policy. So I think other care is going to copy that model. Whether or not you're comfortable offering bankers, is a different question. We decided, and several people in this room decided to take the leap and to get access to their products, though, because it is so important to have this product, in New York, in other states as well. So
Yeah.
yeah,
I would say please don't take this as literal, but I would characterize short-term care as kind of like a little cousin of traditional long-term care. If there was a way to characterize their relationships, I think they're the most closely related products.
well, and I'll take it one step further because there is a little bit more of a direct connection. Is originally when short-term care was approved, it was very non inconsistent with the contract definitions, which is why certain states have not gotten comfortable with it. It used to be cancelable.
Right.
You could buy a policy and the carrier could just cancel your coverage, at their discretion. That is not the case anymore with these new policies because they've kind of mimicked, Jason, to your point, the long-term care contract language. And I would say that we do expect that it's likely they're going to have rate increases like traditional long-term care has had. So I think it's important to disclose that potential and not pretend that this time is different than what we saw in the past, with long-term care. But despite that, there are clients that still are willing to kind of budget for that, expectation, and they're comfortable with that. So I don't think that's limiting. I think it's just important to embrace that it's health insurance, not life-based long-term care, and therefore you're going to have the risk of rate increases.
Yeah, and I think there's tried and true knowledge that we try to impart wherever we can on these study groups, and it's always going to come down to reading the contract, right? At the end of the day, it's something we hate to do. It's easier to do than ever nowadays with your favorite AI tool and summarizing and having it pick out passages in the contract that speak to your general inquiry, right? We don't just go into a contract and expect to read every word necessarily. We generally will open up a contract because we have a specific objective, right? How do we file a claim? Like you said, non-cancelable, guarantee renewable language. Do we have any of that present? Do we not? Right? How do we certify claims, right? How do we get to a claim eligible status with this policy? So I think that's always going to depend carrier to carrier. It can't just be taken as a given, right? So doing that homework is definitely a big deal to understand what you're selling and to be able to set expectations right with the client, right? No back end bad surprises. And yeah, just like you're doing with traditional long-term care, you can't sit across the table from somebody and guarantee there will never be a rate increase. And I think I'm of the same mind as Mark in thinking that short-term care is probably the ripest product to start having stripes of rate increases over the next 5, 10, 15 plus years. I think, do I call it by design? Debatable, but I think when I talk about product design, I talk about levers, right? There are certain levers that a carrier can pull to limit their exposure, whatever they need to do to become comfortable offering the product and to price it responsibly, right? You can have a product that's lenient on underwriting, but it may come at the lever of being more expensive or having a limited sort of plan design. I think I see short-term care right now, especially with a lot of the changes going on in the market and the enhancements to the products. I'm seeing a lack of sort of safety levers being pulled in a way. The true limiting factor of the exposure has always been we're dealing with a 1-year benefit period at max. I know I'm going to pay out 1 year's worth of benefit at a relatively modest benefit, but we are starting to see in the marketplace incredibly high daily benefits being offered on some plans. We're seeing restoration of benefits on some plans with less lenient language that are starting to cross us over that barrier from we're looking mostly at a 1 year to maybe we're looking at a 2-year plan, right? We're starting to see inflation protection options coming out with short-term care and all of a sudden the exposure to the carrier becomes a lot less predictable and transparent, right? So in knowing that, you kind of tie that to propensity for rate increases. Jason, would you like me to show the table comparison of Manhattan Life versus traditional policy pricing? I would love that. I think that would be super helpful.
So can I share my screen?
Of course you can.
Okay, where is it? I gotta find my share screen. Share.
Yeah, Zoom controls are all new lately.
Okay, there we go. All right. So what I did, and what I do with most products when they come out is I do an analysis to just really see how they play in the marketplace, right? So based on age and gender and partner status and different ways of paying, so that you can sort of put this new policy in your brain and where it would best fit, right? So when I first looked at Manhattan Life, for example, I was concerned when you see prices that look too good to be true. So I did a comparison, and I looked at Thrivent, a 2-year policy, both without inflation and with inflation, Aetna, Manhattan Life, and Bankers Life 1 year with a 5% compound, which is their most cost-effective way of purchasing their product. And I use the same monthly premium. So we're talking basically $100 a month. And what can you buy for it? And what do you get for it? And if we look at the total value, so I used a 60-year-old woman going into claim at 85, holding it for 25 years. So either going in at age 80 or 85. And with Thrivent, the person would have $3,300 a month with no inflation, $3,000 with inflation. It's a little better with the inflation at age 85, but maximum they're getting $86,700 as a total benefit. Home Care Plus Aetna, $1,500 a week, 52 weeks, cash, 0-day elimination period. You're still talking $7,800, $78,000. So very in comparison. Within some leveraging with Thrivent, but remember, this is all up front, which is what makes you nervous about some of these home care. These short-term care products, is they're giving all of their money up front, and we do know that there's about a 33% chance of using more risk associated with those first 90 days of care, right? When we look at insurers, what do? They usually charge anywhere from 7% on the low end to 25% on the high end for that home care period. So, and many insurers won't even decrease the elimination period for that first 90 days, right? So, and here we're getting twice as much value in a short-term care product in cash with 0-day. And then I will go to the end just to really compare. And here you have the same with, similar with Bankers. Bankers is a 15-day, again, reimbursement, and you're still at $73,000. And the cash Aetna product is still significantly better, right? Because it's cash; they don't have to pay the $78,000. You have cash, and you get 0-day instead of 15 service days. And then we get to Manhattan Life, right? And we have both a facility care and a home care benefit. And we're looking at 72,000 and so we're going up, so this doubles, right? So you can go up to a maximum doubling of the policy. And so we're looking at $18,000 a month, or $6,000 a month in facility care, $18,000 in home care, upfront in cash, day 0. It doesn't even compare. And between the home care alone is $216,000, and you still get the $72,000, which is comparative to the other short-term care products. So how can a company, give that much more benefit and not have a problem is the question.
I think it's a fair question to ask, and
Yeah.
Jackie also makes a good point. What about the underwriting differences, if any? Because you think about Thrivent in this comparison, they have far more protections in the way of upfront underwriting than some of these other carriers as well. So that has to also be a factor when you think about security of offering the benefit from the carrier perspective. And
Absolutely.
you know,
Absolutely. So you've got, 4 times, 5 times the benefit of these other policies with less underwriting, and all of it front loaded. It's you know, it's concerning. So when would I use this product? When somebody doesn't qualify for some other products and they understand the risk that you tell them up front. There could be 100% rate increase in this, and I wouldn't be surprised if there were, right? And if they don't flinch, then if there's a 200% rate increase, then they'll probably be ready as well. But
Yeah.
it does worry me.
And Linda, I do think also when you say 100% rate increase, we're talking about $106 a month going to $212 a month. Maybe that's not as severe because it is a more affordable price point to start off with.
Right. So here's the key. A lot of people sell this policy as an inexpensive policy, and it can't be sold as an inexpensive policy for people who are struggling, because when they get their rate increases, they're going to be crushed. And that's the last thing we want to do to people. This has a real option for people who want real benefits but can't get it because of medical issues. Then they don't mind if you say, this could happen, 100% rate increase. Well, the cost benefit is still there with 100% rate increase. And for people who don't qualify for something else, it's still a value at $212 a month. So as long as you're selling it to the right people, it makes sense. But you can't say to someone, oh, gee, look at how much you get more for $106. It's such a bargain. You can't afford much. Let's get you a really good policy. Because the potential of a rate increase, in my mind, is pretty high. And then those people can be devastated, maybe having to drop, they may, instead of going up to 212, they'll have to go down and drop half the value of their policy. And maybe they should have started at half the benefit, right? So that they didn't waste that money all those years, because every single dollar to some of these people is so significant. So we don't want them spending money that's not going to have future value to them.
And
So
I think, kind of our message, has always been buy what you can afford to keep,
exactly.
regardless of what the situation is. I think as long as they commit to that budget and commit to that process, I think then you don't run into that as much.
Exactly. Right.
Yep.
So I just wanted to show everyone. Yeah.
This is super helpful, especially putting it in what kind of benefit am I looking at for the same amount of premium? And you definitely do a good job of bringing to light the fact that that's a lot of money to be giving out in benefit, especially in that first 90 days. That's a huge protection for most carriers offering that 90-day elimination period. You see bankers even with a little bit of hedge on a 15 service day elimination period, gives them some time, see if you get through the first 2 weeks receiving professional care and pay benefits after that point. So this is a really nice comparison, definitely super helpful. And I agree, there's still going to be good fits for, the Manhattan Lifes of the world. But you just kind of need to flip the conversation. It's not about designed to remain level. If you, knowing everything can see the potential for rate increases right in front of you with a comparison like this, right? But it's okay to sort of lean into that conversation. I would expect rates to increase. I would expect them to increase X percent if I had to guess. People do buy insurance products that are on an increasing premium schedule. That's to be understood. You just have to be upfront with your belief in the likelihood, right? And the amount and price and purchase responsibly.
Yeah. And Manhattan Life has tremendous value in the sense that, it's a cash benefit. It's a 0-day. You can get a lot of money up front, and it's growing, where most of the short-term products don't, or they are reimbursement like Bankers and Thrivent. So there is value to this for people who don't qualify for other products or qualify for a Bankers, and you say, you know what, you want the cash, right? There's very few products that have cash that can grow like this. So if it may not, you don't have to worry so much about the 106, 212 would still be a huge value. So it's as long as you sell it with them understanding the value, then it can help.
Yeah.
Yeah, and it's interesting. Manhattan Life also does offer to a lower age range than other short-term care products. Am I correct in saying that? I believe they go down to 45, but they also go all the way up to 89 that I've seen.
Right.
So
Yeah, they're pretty broadly. I think the other thing is it's not just about health, it's about process. Some people don't want to go through the process of filling out the long application and going through underwriting. And even though we do it day in and day out, right? So we've kind of become a part of our norm. For clients, they're not moving forward with long-term care because there's just too much going on in their life and they just don't want to spend all that time on this one problem they're trying to solve. So I think the ease of being able to get the policy in place is really important. We're seeing this really popular in the Medicare market. Agents that are
yes.
selling Medicare are running into clients where they're like, hey, if I could add this really easily, no one's ever offered this to me. I'm happy to add my long-term care. I'm not going to like excruciate as much over the cost benefit analysis, right, that Linda's showing. I just want something that's going to be there when I need it, gets the job done, low cost, and I can check the box and move on with my life or get my spouse off my back or whatever it is, right, they're trying to solve for. So I think that process can't be understated. Why people are not purchasing insurance has to do with the process of getting it. So this has a much better process. Linda, can you speak to kind of what the application approval process is?
Yeah, it's very easy, a very easy process. Communication isn't always perfect, but I think they're working on that. I think they've been inundated, so that was part of the problem. And it's one of those products that Medicare people are doing as they're doing the Medicare and they're coming right back with Manhattan Life because it is so easy to get people through the underwriting process and issued very quickly and the price point looks great. And that's the only part I just want Medicare people to be very careful of, that they often, it's one thing if you sell it on the ease of the product, the simplicity of the underwriting, the speed of which you go through underwriting, but when you're talking about how great the cost is, you have to include things that are too good to be true usually are, and there's we have to be realistic that there could be a rate increase on this at some point.
Thankfully, folks that are dealing with Medicare supplements and the like, are already dealing with a health product that is going to have generally year-over-year rate increases. So that is kind of what gives it sort of a synergy with Medicare folks. And I think another thing that gives it synergy that we'll continue to see is maybe their favorite Medicare supplement carrier is offering this short-term care plan and sort of marketing them, not necessarily side by side, but as complementary, sister products for the senior market, right? I think we'll continue to see more carriers that are extremely active in the Medicare supplement, Medicare Advantage space continue to offer short-term care products. I mean, obviously, Aetna's been a leader for a while, but we even see Wellaby is a relatively newer entrant. I think they have some tweaks to make to their product before it's going to spreadsheet out in a competitive way. Their tiered underwriting can be a little bit not only difficult to understand from a process perspective, but can really hurt the value compared to what other carriers can offer the same applicant. But you see Wellaby Medicare supplement owners get pretty significant discounts on their short-term care plan. And we're starting to see a whole lot of add-ins on short-term care products, which, definitely make them feel a bit more appealing, right? At the end of it.
Value-added benefits, right?
Yeah. Value-added services, prescription discounts. I mean, we can take a look at some of the new value-add services on Aetna's refresh plan, but I don't think two hands is enough to count the amount of them. So you're starting to see them play really well with just senior market, insurance products in general. So I think it'll kind of continue in that way. But I definitely think some folks are kind of sitting back a little bit and saying, well, let's see what plays out with these couple carriers duking it out right now before we actually throw our hat in the ring.
Yeah, I do think broadly the short-term care market has kind of evolved into the Aetna Manhattan Life Bankers model, which is more like you pointed out, a long-term care alternative product. And then the ones that have limited exposure but are more about the value-added services, GTL is a good example of that.
Yes.
It's really not about the total benefit or the leverage as much as what can I get, as a cash benefit for a need that I'm more likely to have. They'll give you, a certain amount per prescription with GTL. So you know that by buying the policy, you're at least getting your money's worth that way. I think anything extra you get from the long-term care or the short-term care side, I should say, the 90-day benefit it has, is just cherry on the top. But it's not
Yep.
really designed to solve the exact same issue. It's more to check a box. I think there's
Yeah.
probably like 6 to 10 short-term care carriers in the market out there. But we tend to focus on the ones that have the richer benefits as the long-term care alternative. So that's what you're going to see in the buddy system and all of our materials.
100%. Yeah, Romeo, this is interesting. I didn't realize this, but Romeo said, I've just learned that the prescription reimbursement on Aetna short-term care is only when on claim, not obvious in their printed info. So that's good to know. I'll have to take a deeper look at that myself. But yeah, when we look at underwriting, I would say Aetna tends to be the carrier with the more underwriting sweet spots, I guess I would say, as opposed to, say, a Manhattan Life. The reason I say that is because I just know of two kind of heavy hitter underwriting sweet spots. Number
No
one,
pun intended.
yeah, exactly. So Aetna, no build chart. So you're not going to have to worry about being disqualified for height weight. Number two, they take insulin dependent diabetics, which if you do enough business across a number of carriers with enough clients, you will know that tends to be a really hard one to place. There's only a couple of carriers that are really going to take insulin dependent diabetics. Believe it is under 50 units of insulin a day is what they will consider. So certainly an avenue to look for there. Even if you also kind of know in the back of your mind, well, Mutual of Omaha will take insulin dependent diabetics. You may have a larger uphill getting approved because that case starts rated with MU. Anything else added to that, you're going to be on really, really thin ice, basically already in rated individual consideration territory just with the insulin dependent diabetes alone. So Aetna might be your, your next go-to there. Manhattan Life, just because I have their underwriting questions pulled up, they are going to ask about your prescriptions. Their knockout questions are relatively simple, simple for many to get through. They're going to ask about HIV or AIDS. They're going to ask about Medicaid or early Medicare due to disability. They're going to ask about your ADL assistance needs currently. They're going to ask about Alzheimer's, Parkinson's, Huntington's, and they're going to ask about diabetic complications, which, would include neuropathy, kidney disease, any sort of dialysis, things of that nature. And they ask right up front on the knockout questions, which is why I shout out Aetna on the underwriting side. They're going to ask about insulin-dependent diabetes right on the knockouts. Treatments in the last 12 months, surgeries that haven't been performed, or just have pending test results. They are also going to ask about a few, if you're taking medications for a few problem conditions. They're part twos where they really start to ask about stroke, TIA, diabetes again, and just a handful of other medical conditions. And they'll ask about your prescription drugs. So it's not exactly come on in, the water's fine. But it's definitely a bit more limited compared to, say, your normal traditional long-term care health question experience. Let's see here. Let's talk a little bit about some of the changes with Aetna's short-term care product, because these really surprised me. Number one, Recovery Care Choice is the name of the new product. I think the biggest thing that you could just slap on a billboard is max benefits up to $700 per day, which is why I'm saying we're losing our levers a little bit with some of these products. 700 per day is unbelievable. And even a deal for existing clients to add to their plan up to the $700 max daily benefit with a 15% discount. I thought that was interesting as well.
Yeah.
Only in a handful of states right now. Yep. Go ahead.
Yeah, I want to mention something too. Some people, will have objections about the duration of coverage with plans that are a 1-year plan. But when you're getting a very high daily benefit on a cash, or indemnity style, you can always put the extra money in the bank and have it fund a longer duration yourself. So I think it's also a mindset, right? For me, it's more of the value you're getting for that level of benefit. And if you're getting good value, I don't think you should shy away from it. There may be certain limits, like the IRS per diem limit when it comes to long-term care. I'm not exactly sure if that applies or how it would work related to short-term care payments, cash payments, because generally the those types of benefits can be tax-free. But again, be careful, if you are, I'll say, over-insuring, if you will, the first year from that perspective. But if it's coming out of your insurance dollars, even what you're paying in taxes, that has much less of a sting. I'm getting $21,000 a month, right? $700 a day is $21,000 a month, and my tax bill is $5,000. Out of that, it's coming out of what you're getting paid, so it's not as severe of a concern.
Yeah, and in general, again, we're starting to see lots of riders, lots of add-ins that you can choose from. So I saw the daily hospital confinement indemnity benefit rider. That's a mouthful. Try saying that 5 times fast. If you're confined to a hospital, which includes observation stays, again, maximum benefit of up to $700 daily. Sample policy benefit amount is $10 per day. Let's see. Maximum number of days per period of care is a choice of 3 to 10 or 20 days with a lifetime maximum of 365 days. So this applies when you're on claim and you are confined to a hospital. We talked a little bit about the prescription drug indemnity benefit. They have a bed reservation benefit, Medicare Part B excess charge rider. I believe this is a rider. Pays the difference between the Medicare allowed amount and the actual amount charged by your provider for Medicare Part B claims. So that tends to be a big one. If your services that you're receiving do not accept Medicare assigned rates, Medicare assignment, helping to pay that gap is a really interesting benefit to be able to add. The Recovery Care Choice does come with inflation protection, but as Romeo mentioned, only on facility care, not on home care. Thank you for that. Romeo, have you done much work with the new Recovery Care Choice yet? And if you have, what are your thoughts?
I have, and I've gotten consistent objections to, but it's only 1 year. It's only 1 year. And so by going to a traditional long-term care insurance first, 3, 4, 5 year, whatever you're selling, and then ask them, what if you get all the money in the first year? Now they finally get it. If you don't do that first, they really don't get it. And it's a problem.
Yeah, people think about the probabilities of needing care, but what about the probabilities of only needing 1 year of care or having
What if you used 1 year of care and left $100,000 left for your heirs? How would you like that?
Right. So any other thoughts in how you're designing the plan, Romeo, or how you're using it with clients?
No, basically, I feel more comfortable selling without inflation because getting at 40 years old, ending up with a $2.5 million benefit, they can't do it for that price. There's no way that's possible. And I just like saying, look, if you can get $252,000 in 1 year or $21,000 a month, that's enough for 3 years in an elf. And what do you think? And people are like, yeah, that's cheap. I can afford that.
Yeah.
My market, though, is Joe Lunchbucket, who's not going to buy an $8,000, $9,000, $10,000 a year long-term care policy. My market is the poor people who don't have money, and they love me.
Right. Awesome. Let me see. What else do we have here? So I did see that there is a pre-existing condition, exclusion, limitation on the plan, not covered by the policy, or any attached riders for the first 6 months beginning on the date you become insured. So it looks like a 6-month look back and can't claim within the first 6 months. We see that on some plans in the worksite market as well. Kind of all of your industry standard exclusions. Benefit rider for mental health visit indemnity, up to 20 visits per policy year. So just a lot of like picky choosy things that you can add to the plan as well. I think that's pretty common in the senior market with Medicare supplements and Medicare Advantage. You're starting to see those value added services everywhere. So again, the synergy is pretty clear there. Anything else? Anybody have any other things they want to share about maybe experiences with the new Aetna plan, any short-term care case studies, their thoughts on what they're seeing in the market? Anybody have anything else they want to share here? Anyone position this as something to cover the elimination period and then go with a much longer elimination period on a traditional or hybrid as a catastrophic design? Yes, using short-term care as a gap fill is a very widely accepted practice, but I would say it's probably an underused practice. You know, it does require a little bit of a surgeon's diligence to go in there and make the calculations, but that's what creating a holistic plan or a really customized plan is all about. So I say definitely explore that. Go for it where you think it fits, because short-term care is a very highly accepted gap filler with the 0-day elimination period. Many folks worry about that 90 days, especially when you get to the long-term care insurance personal worksheet on your favorite application, right? When you have to write out that number of how much their care might cost them during that elimination period, that's what gets them thinking, and that's something that could certainly help.
Yeah, let me also add, Matt, I think that's a great idea. I would pair that with Amada Senior Care, because now you have to file a claim with 2 companies. Even more important to have like a claims concierge that can help the client file the claim. So they're able to do it on the short-term care side, and then you have the same kind of person to help you file the claim on the long-term care side. So that's the challenge I see with multiple policies, is just the administration, right, and tracking of what's going on. But I like that, and the diversification of it, you know, in case something happens to one of the carriers or the other, rate increase, it just hedges a little bit, right? That you're not having that disruption, but incorporate that in your process of having somebody they can go to help, so they're not frustrated, you know, with the experience at point of claim.
Yeah, I was gonna
Yeah,
say,
I would.
I was
Go
gonna say
ahead,
at some
Linda.
point that it made, you know, before some of the policies, so like Thrivent is a 7% utilization to get a 0-day elimination period. National Guardian Life you know, where their new product is a 10%. It used to be 25%. When it was 25%, it made a lot of sense to use a short-term product to fill that space. When you're 10% or less, you tend to do better with, you know, just go with the product because it's just easier. As you say, it's just one administration, and the premiums are pretty close. But if you're doing a Mutual of Omaha, which is 15%, now you start getting into the range that you might do better with using an adjunct product, or with products that don't have an elimination period. So for people who are say using like a New York Life, which has a 20-day, but they still have the 70-day for facility care, they might just assume have a 20-day, you know, fulfilled, so they can use, you know, not use their policy for the first 90 days, right? And so they can go right into facility. So there are all those like little things that that can that I think makes that 90-day valuable. But to Mark's credit, absolutely, you want to partner with a home care agency that does the claims, because claims does take time and effort, and you as the agent, they're going to be coming to you if it's a real hassle factor. So you want to make sure, and as in, and if you go to somebody who's like myself who does claims, you know, it doesn't matter if it's a short-term claim or a long-term claim, the process is the same, and so it's a lot of work for a very short payout. So so definitely, if you're planning on that, you got to guide them to an agency that can help them through the claims throughout the whole process.
Actually,
Yeah.
oh, Sorry, Jason, but
Well, what we hear from John and the folks at Amada a good amount is that if people don't go directly to their agent or don't go to somebody like Amada, they may feel that they're in an eligible claim scenario. They go to the carrier, their claim has been denied before anybody has kind of told them, hey, we're pre-claim, but we're not at a true eligible claim yet. All they hear is their claim was denied from the carrier. Oh, I knew it. They never wanted to pay me my benefits anyway. They just wanted to take my premium dollars, right? So I think that's where a lot of the benefit comes in, is that if you build that bridge and they have the conversation with Amada first and say, we're almost there, but we're not there yet to the point where the carrier would approve our claim and start paying benefits, right? That helps the emotional side, the bad case scenario.
yeah, Linda, given that you do like that claims concierge service, I know you have like a fee for service for your higher end clients. Have you run into a lot of short-term care claims, and what's been
I've had no short-term care claims, but what I do, so for long-term care, so like I have a cost for, clients to come in to do the full concierge service. But I won't charge them more than a monthly benefit. So, somebody only has, $3,000 in a monthly benefit. I'm not going to charge them more than 1 month. I'm not going to, so, and then in it. So if I think about these short-term claims that are worth like, that their whole thing is worth $30,000, it's really hard to charge them. I mean, how can you take money from these people and you end up, and I feel like I would almost have to do it, pro bono, which I probably would, but I really would prefer not to. So, it's one of those things that I think using the home care agencies is the answer.
Yeah, and Amada is a good example of that, where even though it's a smaller policy, because the client might otherwise self-fund their services out of pocket for the difference, or, when they run out of benefits, that's still a great client to have built a relationship with for them. So it makes a good business case too, right? For them to be doing.
Oh, absolutely. For them, it's a great thing because they're going to get that they've got all this money. A lot of times people will minimize their care for the first 90 days trying to get through an elimination period, which makes it hard on the home care agency as well as the clients, because the home care agency is trying to minimize the person coming into their aid, out to support them to get through the 90 days, when it would have been so much easier just to get their one comprehensive aid that's going to be in there 6 to 8 hours every day to support that person in home care. So, if they're only using like, 2 or 3 hours trying to get through that elimination period, even though there's a 4-hour minimum, sometimes home care agencies will work with them. It's a different caregiver who works for 2 to 4 hours than the caregivers who typically work, 6 to 8. So they really, they'd like to get that continuity from day one if they can. So it's worth it for the home care providers to have that benefit. Absolutely.
Makes a lot of sense.
Jason, real quick before we just get off of short-term care, one of the exciting opportunities I think with the market is that, as you know, we're doing a lot with the group market, which is usually worksite, people actively at work. But there's this large market where we're seeing, censuses and groups that are retirees, or they're groups where we have an actively at work population and we have a retiree population, and we can only serve, the working population with the group products. I am seeing a lot of interest from the carriers in starting a group short-term care program that would be more designed for retirees, kind of like what we have with True Freedom. So if you guys are familiar with that home care subscription service, True Freedom, we have a affinity group type of program for them. And that's really, I think, the best target market is that retiree population. So to me, I'm paying attention to that short-term care market also because I see the volume of opportunity to offer it to Medicare, agencies, right, that have groups, and we might be able to tie them even to an affinity type of opportunity there, not just an employer. So and that's why I would say also pay attention to this is the market's growing, the carriers are interested, right, which is a key factor is supply of product. We see that that's continuing to increase. I think you're going to see opportunities for, volume types of approaches to this market. And you could picture it being something with its self-enrollment process for a group, right, where people are signing themselves up and you're able to set up a website where people go to a landing page that you educate them and they end up buying the product themselves that way. I think that is where we'll get much more access to the mass market, 65 plus market.
100%. And before I wrap it, I just want to shout out this one page. I shared the Aetna brochure in the chat, the new recovery care brochure. And I want to give a shout out to this page. I just really like it. I think one of the benefits of, having a health insurance, a Medicare provider in this space is pieces like this, right? That talk about where do you plan to, or where are you thinking about receiving your care, or where are you planning on recovering? What is Medicare actually going to provide for you? And finds out that it's very limited, right? Medicare's coverage for long or short-term care has always historically been limited, or had certain conditions or hoops to jump through in order to have Medicare be a payer on it in any way, right? Even for skilled nursing care in that first 20 days, you got to be admitted as an inpatient for at least 3 days, right? And talking about where recovery care choice will come in and actually help you where Medicare may not, or may not help you enough. So I thought this was a really interesting piece. I think many of the people in this market that you will be talking to are of the age where they're thinking about Medicare, and they may think that absolutely all of their bases are covered. Turns out that they are not all covered, and this is a very important one to cover. So yeah, I just really like that synergy there. I like a lot of the incumbent long-term care carriers just kind of think of it from a policy benefits perspective, from an emotional long-term care perspective. And I like that Aetna kind of puts the spin on the Medicare perspective for the senior market. And I think if I were to wrap it up, obviously there are, things to watch about short-term care, positive and negative / unknown, right? But I think one of the things that it is absolutely doing that's a great thing to always take away is that it's giving us access to coverage for a lot more people than ever. And at the end of the day, this industry has done so well in having solutions pop up that serve a portion of the market that previously couldn't be served, for underwriting reasons, for age-related reasons, for financial reasons, right? And short-term care meets a lot of those previously blocked markets. Affordable pay-as-you-go premiums. In the case of Aetna's plan, offering down to age 40. Short-term care plans, many offering to people as old as 89, right? And some interesting underwriting niches, and at the very least, a simplified underwriting process. So it brings a lot of good to this market, but as always, our due diligence is going to establish our barometer, our appetite for who we offer this to. Is it very limited situations or very broad stroke situations? But it fits a lot of interesting gaps. It's an interesting arrow to have in your quiver always. And I guarantee you, at some point down the road, it could help a client who you previously couldn't help before. So I would definitely keep it on your radar, whether you're in an approved state or not. For clients out of state, just always good to know this stuff. And I appreciate everybody's contribution to the conversation, whether it be speaking up on product. Linda, the comparison was wonderful. Or if you just ask questions to help everybody learn, I really appreciate it. And I think that'll do it for today. If you are interested in the worksite side, and maybe you're even interested in products outside of long-term care, we're going to have the Standard as a guest on our Thursday worksite study group. We're going to have Tyler from the Standard on that study group call, and he's going to talk us through the Standard's very reputable disability offerings, so long-term and short-term disability for employer groups. So if you're interested in that, that's what will be going on Thursday. Otherwise, I will see you this time next week. I appreciate y'all. Be well. We'll talk to you soon.